Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for tuning in and watching the channel where we are dedicated to the hunt for cash flow and intrinsic value. This channel looks at 5 key attributes for all stocks: the top line revenue growth, EBITDA growth, earnings growth, free cash flow growth, strong balance sheet, and a well-priced stock for a good investment. We hunt for the intrinsic value. We figure out what we think the stock's worth, and then we look at the stock price to see where it is trading and if there's a difference there. I do it that way because if you look at the stock price first, you will instinctively believe that the stock market is correct, and you'll adjust your analysis to justify the prices of the market. Going through and finding cash flow, figuring out what you think the company is and what you'd realistically pay for it is a great way to smell check what the market's doing, especially in times like these when the market's getting a little nuts. It is. Be careful. Make sure you're buying cash flow. Make sure you're not speculating on price. Remember, there's 2 different types of investing. There's speculating, which is like going to Vegas and just gambling, throwing money on blackjack and seeing if the stock goes up, what happens. And then there's investing, which is buying cash flow and holding it for a long time. You can make money doing both. A lot of people lose money buying and hoping that the stock's going to go up the next day or next earnings call. That's not what we're about. We're about building a fortune long term. I mean, that's the idea. 10, 20 years from now, how do you become a millionaire? You buy the top performing stocks, you hold them for a long time. That is a great recipe to make a lot of money, and a lot of people have done it, and we try to replicate that here in this channel. Okay, enough about that. Let's go look into Chipotle. Today, we're going to look at Chipotle. I've got the 10K behind me. Highly recommend you go through and read this very, very interesting stock. They're doing a lot of stuff, and they've certainly rebounded from their E. coli breakout. I think it was E. coli that they had, a couple years ago. The stock was pretty depressed, but they bounced back. And let's take a look at the financials. So behind me is 8 years of Chipotle financials. Let me zoom in so you can actually read this. Should have done that earlier. Here's the revenue. $2.2 billion of revenue all the way to $5.6 billion. Excellent. That is a 12% growth rate on a retail chain location. Love to see that. That's extremely healthy, especially because they had this dip right here in the middle, 4.5 to 3.9 to 4.5. So they recovered quickly, and that's great to see. And it's this year 16 is going to kind of cloud the numbers. So you got to look like pre-16 and post-16 when you're looking at the business. But it's very interesting. So with that, still managed a 12% growth rate. EBITDA is strong. EBITDA is growing a little. Well, EBITDA is growing at 6%, but again, 6% includes this monster down year. So I don't think you can really count that. Basically, look, kind of averaging here and then averaging here as they rebound. That is growth. It's not probably as much as we'd like to see. It looks like they were pretty strong here. $828 million, so I'm getting my zeros, on $4.1 billion of revenue. Here, $5.6 billion of revenue, $700 million of EBITDA. So the EBITDA margin's a little weaker. That might be to systems checks that they've put in place since the outbreak, but still strong top line revenue growth, good margins. That checks the box for me, and certainly recently, their EBITDA growth rate has been extremely strong with solid double digits. So I think that checks both the first 2 boxes for us. Let's look at the EBITDA buildup and debt level and see where they stack up. You'll notice they've got no debt, which is what we really, really, really like to see. This here, $2.6 billion, this is an operating lease that they had to capitalize. So it's not like a bond. It's lease for equipment or rental space. It's a long-term lease that they're on the hook for, but it's not exactly the same as a debt. I've put it here just to merely make a note for it, but I consider them debt-free. They have excess cash, so despite everything that went on a couple years ago, they've still been able to build cash on the balance sheet, which is a great thing to see, and it means they're actually making money if cash is piling up on the balance sheet, so that's good to see. Market cap, they've gone from $10 billion to $23 billion. and you can see the hit that they took with the fall. They went from $20 billion as a high of market cap down to $8 billion. That's a strong move, and that is probably because of the E. coli breakout that they had, and just affecting earnings and people just fleeing the stock. You can see they went from a 24 earnings multiple, enterprise value to EBITDA, to an 18.5 EBITDA multiple. And that's how fast something like that can happen. It's a strong move. If you're trading at a high multiple, you can drop quickly. But they seem to have recovered, seem to have made lots of cash flow, and as a result, they have been rewarded with a very rich multiple. They're at 47 times EBITDA to enterprise value currently, which, make no mistake about it, is a very rich valuation. We're seeing a lot of money come pouring into the capital markets, and that money is going to stocks such as these that do have a good growth. From what I can read and hear, I think the other day I was on Bloomberg, they were discussing the outlook for Chipotle, and Chipotle is saying that they're going to start rolling out drive-thrus, and that they've been able to monetize with their app and get orders digitally. That is something that Starbucks did many years ago, and it worked very, very well for them. And I'm optimistic, and I'm interested to see that kind of that same correlation play out for Chipotle, which has excellent fast food. So let's recap. We've got strong revenue growth, strong earnings growth, like EBITDA as we define it when we look at the entire enterprise, not net income. Debt levels 0. They're built cash, fantastic. Well priced. They're expensive. Let's not make no mistake about it. We'd rather have them at 20 times. I'd rather have them 18 times, but they're at 50 times right now, which is high. Let's see if the growth rate can substantiate that kind of number. Let's go look at cash flow. Cash flow from operations started at $411 million. It's gone to $722 million, and an annual growth rate of 7%. Again, that's in line with the EBITDA number, with the revenue number. So cash is smell checking to the accounting statement, which is nice. It also means that's why they're building cash on the balance sheet, because things are moving in the right direction. If you look at CapEx, so CapEx is pretty consistent. About I think that averages $240 million a year that they're putting back into the existing restaurants and then into new restaurants. What we really like to see here is the spread. This positive 722 less the reinvestment leaves what's that, about 400, excuse me, it's getting late math and stuff, 400 million of cash. They have 0 debt, so that 400 million falls right to the cash flow statement, which is fantastic. These guys don't pay a dividend, which I believe, I actually didn't even look that up, so shows you how little I go to Yahoo Finance and look at the metrics. I'm really just reading the 10K, but if they did, they'd pay a small piece of this. If they don't, then that money is stacking up in the balance sheet, and that's why we're seeing excess cash pile up. So kudos to them. But we'll keep going. So we got shares. It looks like they are actually buying back some of their shares. So shares are being repurchased 1% annually over that time frame. Shares, cash flow per share is strong, $13 per share. I'd expect a high share price if cash flow per share is that much. There you go, $825 at the last fiscal end for a cash flow yield of 1.68%, which is it's a yield that reflects a growth company. Sub 3% is something you expect, a tall multiple like we've seen at 50 times EBITDA. Growth rate, 6.5% is the geometric average. Again, kudos for the guys on the channel that are pointing out the geometric is better than average. Appreciate the comment. So 6.5% is the average growth rate on the free cash flow. EBITDA was 6%. That ties, they've got no debt, so free cash is passing right through. So the financials look good, look very good. Let's look at growth and figure out where we're gonna go from there. So I'm giving them a healthy growth rate, 20% year over year in free cash flow, and then bringing that down over time, really not very much. Why? One, I'm seeing long-term growth rates in the market that is putting EBITDA on pace for this growth rate. So I'm basically matching EBITDA. Two, I think the landscape for retail fast food is huge, certainly with their health bit. And I love the fact that they're going to do drive-through, and I love the fact that they're making use of digital apps. So I think the sky's the limit for these guys in terms of the market landscape. What does that mean in share price? Well, I'm taking $13 a share, I'm growing it over time, and I get to basically $60 of free cash flow a year in 10 years. And I apply a yield to that of 3%. Again, they're trading right now at 1.68. So I'm giving them a higher yield than they're trading at, being more conservative. That puts a $1,900, almost $2,000 price target. Just for fun, if I chose that to 1.68, which is their current yield, that's a $3,500 price target. So I'm being conservative at the 3%, and I think there's upside there if they maintain that yield. Let's go look at EBITDA growth. So EBITDA, same thing here. This EBITDA growth rate gives me a long-term target EBITDA of $3.5 billion. That's the growth rate I'm seeing out there in the street. So I'm just matching growth rate to reflect the long-term value of the EBITDA that I'm seeing. And it smells checks to me that they can do it. They've grown at this rate previously with revenue and EBITDA at 6%. But again, I think them expanding, I think the drive-through and the app could give them the possibility of growing at that rate. So that at a 20 times EBITDA to enterprise value multiple, right there at 50 right now. So I'm saying naturally they're going to come down as they get bigger. So I'm bringing that down. That still gives me $70 billion of value. No debt, very little cash, basically rolls through to market cap, less shares. I'm not shrinking the share count. I left it at 28. That gives me a $2,500 price target out 10 years. So we've got two price targets. Basically, you've got $1,900 from the cash flow model, $2,500 from the EBITDA multiple model. Again, if you took the yield from 3% to 1.6, you get 3,000 price. So I think there's some upside to this in terms of multiples. I'm trying to be conservative. Last time I checked, price target 1,082. Let's throw it into our handy dandy IRR calculator. So you've got 1,082 as the price target. This is the cash flow. Again, I don't know if they dividend it or not, but this would be reinvested to get the growth that they're growing, or they could kick it out. They seem to have plenty of cash on hand. That produces an 11% IRR over the long term, which I think is a solid return for a growth stock with some upside if they maintain the high EBITDA multiple, if the yield that they maintain in the future is lower than 3%, there's upside here. So that's a 2.4% time on your money over time. Let's look at the distribution curve. So again, here's the stock price, 11%. As the stock price comes down, if it does, it goes up to 15%. If you're buying the stock above $1,500, $1,440, you're at a mid-single digit IRR, and you're really going to be dependent on higher growth or higher multiples to get where you want to go. But if I just take the EBITDA number that they have out there in the street, not Chipotle, they have an issue, but analysts are saying that they can do it. Okay, I'll take their word for it. Then that's 15.5% growth, kind of annualized. That puts it at a 3.5 billion at a decent multiple, 20 times. I think they could get it. So I'm going to give this a good investment. Why? Let's recap. Good revenue growth, good earnings growth, free cash flows matching EBITDA, and that's growing. Excellent. They've got a strong balance sheet with no debt, and they're well priced. It's expensive for multiple. I would want it cheaper. I get that, but can't say no to everything. So if you're gonna betting on a company that's got good top line revenue growth, good earnings growth, zero debt, and in a market landscape that they can use drive-throughs and digital ordering, I think that smell checks to me. So I think it's a good deal. Let me know what you think. Appreciate the comments, the questions, and don't forget to hit the subscribe button. This has been Chipotle. My name is Cameron Stewart, CFA. Thank you for watching Rational Investing. Take care. Bye-bye.